Welcome, everybody. We're excited to have you on today. If you're on this webinar, you're kind of what I call the hardcore Capita clients. I mean, you guys are, if you're taking time out of retirement to talk about inflation, either you're really concerned, which is valid, or you just geek out on this stuff. And we're happy to have you. We're excited to have you here. And I'm going to tell you a little bit about Monica. Many of you know who Kurt is, but I think this will be the first time hearing from Monica for many of you. So you'll really enjoy this presentation. This presentation came about because I had one particular client who was interested in understanding Treasury inflation protection securities, commonly known as TIPS. And this client was asking me a bunch of questions, and I just knew the right person and the right team to talk to are Joshua Flade and Monica Sonnier at Townsquare. These two understand tips really well, understand inflationary pressures. And I think this is something that not a lot of people realize, that bond experts are the ones you want to talk to about inflation more so typically than in any other investment expert, because bond specialists have to focus so heavily on interest rate changes, which is so closely tied to inflation. So they keep a really close eye on what types of assets best keep up with inflation, and how bad bonds perform in high inflationary environments, or how that works out. So they have to keep a really close eye on all of it. And we're excited to have Monica here today. So let me give you a little bit of a background as to what we're hoping to cover for everybody. And then logistically, if you are in this webinar, the best way to keep it live and keep it fun would be just throw in your questions as you go. Between Kurt, Monica, and me, I think we're all very accustomed to dealing with on the fly questions. So just throw them in. We'll deal with them as they come. And if there's a reason to postpone one, we will. But my guess is we'll just tackle them as they go. Keep it really conversational. I would love for this to be really useful for you. We're not here to present for our purposes. I mean, really, this is for you guys. So throw questions in. Let's see what we end up talking about today. The rough agenda is really, let's just talk about, if inflation comes, then what types of assets perform well in inflationary environments, and what can you do today to help prepare your portfolio and retirement for inflation. So we have Monica and Kurt on today. And uh, Kurt, you guys have had many opportunities potentially to listen to Kurt and I talk about markets and different aspects of the economy. Kurt worked on Wall Street, worked managing a fund, and is now the chief investment officer and founder of Townsquare Capital. So Kurt is overseeing all of the different asset classes and portfolio construction and manager selection. And Monica is extremely deep into the fixed income side of Townsquare. So Monica is one of those just really bright, quiet types, sits in the back of the room and then doesn't comment for a long time. And then all of a sudden she starts talking, and you're looking around like, whoa, where's this lady been this whole time? So she's just wonderful. We love having her as part of our investment team, and we're excited to talk about all of this today. I'll put this slide up at the end if you guys want, of course, to be able to contact or get other info, but don't stress about writing that down. Monica, I've stopped sharing. And I think what we do, I mentioned this client wanted to understand more about tips. So Monica and I and this client, the three of us had a call, and we got done with the call, and I thought, oh my gosh, we need that for the rest of our client base. So we're recording today. We'll put this up on our YouTube channel, which makes us feel young to have a YouTube channel, but we'll get it up there and you guys can watch it later or pass it along to others. Monica, I'm going to go ahead and, if you don't mind, you can start sharing your screen. Is there anything else that you think I should mention or you should mention before we get going?
No, that was an awesome introduction. Thank you so much.
Good deal.
Yeah, no, you guys seeing the slides now?
We see it.
Great. I'll go ahead and start my slideshow then, make sure everybody can see. Great. Um, well, yeah, no, that was a great introduction. Thanks so much for the kind words. Yeah, this is definitely the arena for us bond nerds. We can geek out on this all day long because it is, as you said, very, very integral to, what goes on in the world of bonds, what drives interest rates. Inflation is one of those, I call it the three-legged stool, the thing that the Fed is really looking at to decide whether they think they need to lower or raise interest rates, they look at inflation, they look at growth in the economy, and they look at employment. And that's the three things they're looking for to be growing but steady. They don't want huge amount it's kind of like the Goldilocks. They want a little bit of growth, but not too much. They want a little bit of inflation, not too much. So that's something we're just constantly watching, try to get a read on where we are going with rates. So what I wanted to talk about today is, as Zach mentioned, we are getting lots and lots and lots of inquiries about inflation and whether it is, is it a thing? Is it something I really need to be worried about right now? And it has been a lot in the news. If you watch CNBC and the business news, it is a lot in the news, and it really has been behind what has happened with interest rates over the last month or so. We were sitting mid-February about 65 basis points lower on the 10-year Treasury, that's a big move for 1 month to happen in the fixed income world. Things typically just don't happen that quickly. So it is a big move, and it really has all been driven by just this fear of inflation, which we don't think is entirely out of bounds. It's not an unreasonable fear given what is going on, with the government, particularly with stimulus and so forth. But for various reasons, we do think, it's not a huge concern or and even maybe a little bit of a head fake, at least in the short run. So I'm going to talk a little bit, first about just, what it is, what is inflation, what typically drives it. We can get inflation or deflation. And, typically if we're getting inflation, it's because a number of factors. It's not ever just one thing, but rising commodity prices or, the price of input goods can be rising. A tight labor market is generally seen as something that's going to be inflationary because if jobs are, very plentiful and there aren't enough people to fill them, then people can demand higher wages. So that will lead to wage inflation. A lot of fiscal spending on the part of the government, and this is the big thing that everyone is, concerned about right now with all of the trillions and trillions, it's real money now that they're throwing out there, not only at COVID, but now they're talking about a big infrastructure spending bill as well. So lots of money out there. But one thing to remember, and we're going to talk about this a little bit more, is that lots of money out there flowing in the economy can be inflationary, but only if it does flow, through the economy. And we call that the velocity of money. If people keep spending, every dollar that they get in. Another thing that can be inflationary is a weak dollar, and that's just basically because it costs us more for the imports that we bring in. But expectations of inflation is a big thing that brings about inflation. And yes, it's a kind of a self-fulfilling prophecy, but it does happen that when people are expecting more inflation, you will see particularly longer term rates getting pushed up. And people do expect that when we're in an expansionary cycle, which, we think we are headed into that post-COVID. So what can bring about deflation, and we've seen some of this in our history. We haven't seen a lot of those periods. Tokyo or Japan went through a big deflationary period, the lost decade, they called it. But, we haven't seen tons of it, but we can see periods of it, particularly when the economy is contracting, like falling commodity prices, other input costs falling. Technology is a big driver in deflation and also in just keeping inflation at bay, because when technology is increasing the quality of the goods and the utility of the goods that we use, it brings prices down. But remember that when they're factoring in the cost of all this technology and things like the CPI and the PCE, they're measuring it on a sort of a level playing field in terms of quality. So for instance, if you have an increase in the technology in TVs that allows you to get an 85-inch TV for what you used to pay, for a 65-inch TV, it's not an increase in cost if that TV costs you more, because the TV you would have bought if there hadn't been the increase in technology really costs less. So that tends to be driving down inflation, or even again could be tipping into deflation. Globalization, just more competition from economies overseas and also some type of a massive economic shock that reduces the demand for goods, and that usually has to be something that's really big and lasts a good long time. So, think COVID. Yes, it remains to be seen whether that's going to end up being something that lasts a long time. It hasn't been that long, but it certainly was a massive shock, and we saw that back in '08 and in a lot of recessionary periods. And on the other side of the coin, the strong dollar, just the opposite of a weak dollar, a strong dollar would typically be deflationary. So
Monica, it
that's
seems like COVID just wasn't even enough. I mean, don't get me wrong. I'm not trying to downplay the fact that it was devastating mentally and financially for a short period of time, but it seems like that in particular was just not prolonged enough to create much of a deflationary pressure. Is that true, or is it no, it did actually create a decent amount of deflationary pressure?
I think it did, but just for such a short period of time. And it really, a lot of it would just went into the disruptions in the supply chain as well. So it's kind of been both sides of the coin. There has been some inflation, and we're even, we are starting to see some signs of some uh, pockets of inflation, if you will, in the economy that were caused by COVID because of the demand being so great and the supply chain still being somewhat disrupted. So it is a thing, but yeah, you're right. It was such a fairly short-lived thing that it didn't really create a lot of systemic deflation. Yeah. The thing that's really been probably the bigger driver in the move in interest rates over the last month has just been that fear of inflation brought about by the government, spending so much money, all this government stimulus. And again, that's why I say it's not an unfounded fear, because that is typically something that is going to create a lot of inflation. Conventional wisdom says that if the government's spending a lot of money and or you have a big economic rebound, that you're going to get inflation. And while that's generally true, it can be very different in terms of both the timing and the magnitude, of what that inflation looks like. So what we want to look at now is just whether, do we need to be really that concerned about massive or hyperinflation? And, spoiler alert, I don't think we do, particularly, although I do think we are going to see a few, again, pockets or little upticks in inflation. So I'll make my case, for why I don't think it's a huge concern. I think we are going to see a little bit of an uptick this quarter, maybe even a little into the next quarter. But a lot of that is just because, when the way they measure inflation on different types of goods and services in the economy and all of the overall indexes, they're measured off of some base. And the base is a year ago. And a year ago, we were in the middle of COVID and everything, was down in the basement. So when you start measuring increases off of such very, very low base points, you're just going to see big percent increases. So it's going to sound scary, I think, for a few months, but we don't think that most of those changes are going to, continue to certainly not sustained at the level that we're going to see
Monica,
this
is it
quarter.
fair to say then, for example, what you were talking about, the percentage change, that if we had 1% inflation and then all of a sudden we got to 1.5% inflation, some of the news headlines could read a 50% increase in
Right.
inflation? Okay.
Exactly.
So
Exactly.
this is where, like, folks, you have to, I mean, every news outlet has its own leaning, right? And you have to try to read through that context. And people
Yeah.
can play games with numbers, I should say. But a 50% increase is the same as 1% inflation turning to 1.5% inflation. We've had such low inflation that anything is going to sound like a big change, right?
Correct.
So I,
Correct.
I have a
And
question. Go ahead.
yeah, no, go ahead.
Well, the question has to do with I think sometimes we associate the word inflation with negative, that it's a bad thing. It's
Mhm.
always a bad thing.
Yeah.
And I think maybe that was the 1980s and people having to borrow at in the teens to buy a home, which is an awful thing, right? But that's not necessarily the word inflation itself isn't a bad thing. It's high inflation. So can you clue us in on why does the Fed actually want some inflation? Why is it good for us to have a little bit?
Yeah. Yeah, that's a great question. I get that question a lot. It's like, why should we have any? And again, it's one of those Goldilocks things that a little bit of inflation is seen as a good thing because several reasons. When the biggest reason probably is just the expectation factor for people. For instance, if you're looking at making a purchase and we've had sustained deflation for a while, so you pretty much know the price of that whatever you're going to buy is going down, right? Would you be in a big rush to buy? No, you're going to hold off, you're going to wait. So it has a dampening effect on spending, which is a huge part of our economy. So we don't want people to be sitting around waiting for prices to go down. So that's a big factor, but also just the wage, the psychological issue of wages as well. People, if their wages are not increasing, they don't feel like they're very well off. They don't feel like they're doing very well. So yeah, so there's a lot of factors, mostly psychological, that have to do with why a little bit of inflation is a good thing. But as you said, a lot of inflation is not a good thing because it has really the same effect, dampening down demand for goods, and making it extremely unpredictable for both producers and consumers. And so, that really wreaks havoc in an economy, as that typically only happens in extreme economic shocks, like we see maybe in Greece recently or post-war, Europe, Germany, things like that. Doesn't happen too often, thankfully, and probably the closest thing to it that we've seen was in the 70s, and that was really driven by oil prices. So.
Got it.
Yeah, so a little bit is good, a whole lot is not very good, but we think the Fed has been looking for 2% for a long time, and they haven't gotten nearly that much. Inflation's been very, very subdued for quite a while. But even though the factors that you would typically think are that need to be there for inflation, like massive government spending and lots of demand ticking up, pent up demand after COVID, that these things would lead to inflation. And while we think again that there may be some small pockets or little upticks that will be a little bit scary the next quarter, this quarter, maybe the next, we don't think that the factors are there for very long-term sustained inflation. And that's mainly in the velocity of money. And again, that's that factor where, I spend $1 at somebody's business, they spend that dollar somewhere else, and, money circulates in the economy when there's lots of demand. And they, if you ever took economics, they called it lots of money chasing too few goods. That's basically what it allows to. So you do get that increase in inflation. But we haven't seen that. That hasn't been happening. And you've probably heard, the news stories as well, that people getting stimulus payments are generally saving, if not all of it, a pretty large part of it. They're not doing massive spending. There is some, pent up demand in spending that's happening. But by and large, it's just not, it's not contributing to that velocity of money to the point where we feel like it's going to be driving a lot of inflation.
Yeah, Kurt
And
mentioned this on our last market webinar, market update webinar, that there's a huge that velocity of money is an aspect of inflation that I think most investors in our just normal individual investors miss. We all understand that there's more money because of stimulus,
Mhm.
but we don't understand that if that money, let's call it, goes to rest or dies in the bank account, then it doesn't have as much inflationary power as if it's purchased, it's spent at a fast food restaurant or buying a home, and then that business is buying more equipment, and then the home is being furnished with furniture, and it keeps going, right? So if that dollar could be used 5 times in the course of a month or two, then we've got a different story than if it goes to rest in a bank account for 5 years, right? So
Correct.
anyway, I
Right.
think that's something that is hard to measure because it's easier to measure the amount of spending being done, but velocity of money is tough. It's tough to measure. It's tough to understand too. I just
Absolutely. I think I like to think of it as, contributing to the supply demand imbalance, because, at the core of it, what's going to drive inflation is if we just have way more demand than we have supply, in general for everything. And so, yeah, you're right. If those dollars just go in a bank account, or even if they're invested in something else, if they're not driving that demand to where it exceeds the supply, then we're not going to get inflation. So. So a couple of other things I wanted to note just here again, kind of making my case, for why I don't think that we're looking at huge inflation way down the road, is that inflation also tends to lag the start of a recession. And we, even though we may be looking at an increase in economic activity, mostly pent up, after COVID, or even if we continue to see that after COVID, typically inflation does tick up a bit when we get into expansionary periods, but there is a pretty good lag, a year to 2 years. And this chart is just kind of showing, in the shaded areas is where we had major recessions, the 80s, the early 90s, 2001, 2008 to 9. And you can see that, when you're going into the expansionary periods right before that, inflation is ticking up, but it doesn't start to do that until you're a year or two away from, the end of that recession. So, if you again want to say that we had the recession already, that it's done and it's over from COVID, and it was pretty short-lived, then we could still be looking at another couple of years to get into that expansionary period enough to where inflation starts to pick up. So that's traditionally how it happens. Also, there's a couple of things that are kind of unique to this particular downturn, and everyone is a little bit different. These factors that we look at in the charts, it may look like maybe there's some grand equation here that if we could just solve it, we'd figure out exactly what's going to happen. And the truth is, every recession, every expansion, every downturn, they're a little bit different. The factors that cause them and the factors that contribute. So what's a little bit different this time, people are looking at what's going on with housing and the tremendous demand. And yes, housing prices, ticked up quite a bit almost everywhere. You would think, yeah, this has got to contribute to a good bit of inflation. But the way that the price of housing is actually measured in the components of the inflation numbers, particularly CPI, is what is called owner's equivalent rent. And so what contributes to that, apart from just the price of real estate, it is actually the price of renting, leasing. And so there's a cycle there. People sign typically 1-2 year leases, maybe even more. And so as prices get adjusted, it takes a while for those increases to work their way through. And additionally, because of COVID, and there being a lot of real estate that's empty, it's going to take a while before landlords are really able to push up those prices. There's still some areas where they're almost giving away, rentals. So we think that that's going to take a while to work its way through. So while there's going to be some component of that working its way into the inflation numbers, it's again probably going to be quite a lag. It's going to take a while to get there.
Hey,
Another,
Monica,
yeah.
can I add one piece of
Mhm.
color on that comment about housing? What's really interesting is because mortgage costs have come down so much over the past 30 years, the average mortgage in the United States as a percentage of income to that household is actually at the same level it was about 30 years ago. So we feel like there's been this huge bubble building in real estate. But your point about rent combined with the cost of getting a mortgage, we actually have not seen a real net change over time as a percentage of your paycheck of what it costs to have a mortgage. So it's kind of, anyways, I thought I'd just add that color in there to
Yeah.
that.
No, you're
Kurt,
Conversation.
you
Right.
and I both loved there was an article put out on Twitter by Ben Carlson that talked about this, and he went
Yeah.
through and laid out housing prices have gone up over time, but interest rates have gone down, and the net effect of actual monthly cost of ownership has stayed pretty steady over time. And then if you layer on inflation to it, it's actually a little less expensive right now than in many times in the last 2 decades, to buy a home. And I'm seeing this firsthand. I'm selling this house I'm sitting in right now, and I'm selling it to my sister because she needs to buy a bigger home. She was in a starter home, right? And I bought this home in 2011, so I've been in it for a decade, and it's doubled in price over this decade. My sister's monthly payment will be the same as my monthly payment when I bought it a decade ago. And
Yep.
we weren't coming from another home. We put 5% down to buy it. My sister's in a starter home. They'll have a little bit of money. When I say a little bit of money, I shouldn't say a little bit because their house has gone up too. They'll have $100,000 or so to put towards it. But the point I'm trying to make is I paid about $2,000 a month and they're going to pay about $2,000 a month. And the house
Yeah.
is twice the value. I think that illustrates the point that we're talking about here, where housing is kind of, it feels crazy, but it might not be, right?
Yeah, and I don't want to take us down a tangent on this real estate thing, but Monica's point about rents are interesting. It's become more expensive to rent, but not really actually more expensive to buy, over the last 30 years. And we it's what's happening in real estate. And Zach, you and I have talked about this a lot. It is, if we are at this moment, this last quarter, 72% of all mortgages originated in the United States were to credit scores above, what is it? Seven, I
700
don't know
and
what it,
something. Yeah.
it's that highest group of FICO scores. And almost no movement in subprime. So a lot of what's happening is it's very high quality type of buying. The average down payment is higher. The mortgages are better. I mean, so I'm not saying real estate isn't overpriced in the short term or something like that, but it's not the kind of, bubbleistic behavior that we had seen in 05, 06, 07,
Yeah, I think that same stat was in the 20%, 20 or 30% of
Yeah.
people over that 700 credit score figure
Yep.
back then. So yes, it seems to be different. And like you pointed out, like obviously prices could come down a little bit. We're not predicting that they're just only going to go up, but anyway, that's a really good point. So let's keep going on these other topics, Monica. Go
Yeah,
ahead.
sure. No, those are great points though. Another thing it points out though also is just that so much of what's built into here is expectations, about inflation, not necessarily real inflation or where real inflation is going. So people's perceptions play a huge part in that. But
You know what?
um,
And I don't mean to pause you again, but I'm gonna do it because I got another comment. I'm just chatting with somebody in the comments as we're going here, and the comment was about, well, why were the stimulus checks actually needed if a lot of them went to bank accounts? And I think the theme that I'm hearing and I know is true is psychology. What you just mentioned, Monica. It's that fear in psychology. Having some extra money in the bank account changes the way you feel about your investment portfolio, that makes it so you don't put as much selling pressure on it, which puts less selling pressure across the whole market. And the fear of inflation can create inflation. You can see how there's so much more to investing than the hard numbers of, well, we're seeing these factors. So, X factors are happening. Y should happen. It doesn't quite work that way. You got X factors, but people feel a certain way, and we're not sure how those things all play together to determine the true outcome, right?
Yeah, absolutely. Absolutely. Um, so we'll move on here. A couple of other factors, that I wanted to mention again for, making my case for why I don't think we're going to see huge inflation is energy, which is a big component of inflation as well. It has been trending lower over a very long period of time, and notwithstanding what's happened since March of last year. Obviously, most people remember oil going to negative values, which is pretty mind blowing back in March, and it has popped back pretty nicely to where we're pretty much back at a level that we were at over a 10-year period or so. We're in the low 60s on oil prices. So, but the price over a very long period of time has been trending lower because of things like fracking and just the overall supply of oil. And we think that's going to probably be a continued longer term secular movement that will continue to see those prices over a fairly longer period of time decline as more alternative energy sources become more price competitive and price effective, and particularly as the inflation measures eventually they're going to start to take that into account. They don't really take that into account now. So
That was your
so that's
technology factor. That was your right. That's technology
it's
keeping
another
inflation.
another thing driving
Yeah.
technology driving some prices down. And but again, and another thing to remember that technology, another component of that as to how that drives the inflation number or deflation, typically as it is the case, is the utility factor, because they measure that that price per amount of utility, if you will. So again, you might be paying a lot more for an 85 inch screen TV, but that 32 inch that you would have bought 20 years ago is a lot cheaper. So so that's the utility factor. There we go. So those reasons, I know it gets a little bit into a little wonky into the statistics of how inflation is measured, but that's really important. And as we just said, a lot of what actually drives rates is not necessarily those particular numbers or factors, but people's expectations. All the things that we just talked about. We hear real estate prices going way up. We hear the government is throwing money out the window. Then people will expect more inflation, and interest rates will react to that. And that's really what we've been seeing. So the last part of the discussion then becomes, we know that there are factors out there that could be driving some inflation. We feel like it is going to be a little bit short-lived, and probably, we do think inflation is going to tick up slightly, but it is going to take a long period of time. These things generally do take a fairly long period of time. Both changes in interest rates and changes in inflation take fairly long cycles to work their way through the economy, and that's just kind of as a sidebar, that's another reason I think that a lot of the recent movement in interest rates is a little bit overdone, a little bit of an overreaction, a fear reaction, I call it. I've been watching these things and doing bonds for like 30 years, so I've seen quite a few pretty gut-wrenching movements. I always tell people, if they try to tell me anything to scare me, I always say, you can't scare me. I've been in bonds for 30 years. There's been some scary stuff that's happened, but the scary stuff, the real gut-wrenching moves like we had last March. I mean, that's one that goes up there in the pantheons of my career of, big scary movements. But, 2008 and 1987, there's been some gut-wrenching moves, but those kinds of fear reactions typically are pretty short-lived. They snap back pretty quickly. And now, even though as a longer cycle, we may be seeing a little bit of an uptick in inflation that will come naturally along with increased growth and increased employment. We just don't think that it's not going to be 65 basis points every month. That we just don't think that's going to happen. But if you feel quite fearful about inflation and you really want a way to protect yourselves, then we can talk about how do you insulate your investments, if you will, from inflation. And people often talk about different things that can hedge inflation. Gold is usually one of the things that's mentioned more often than not. So we really wanted to take a look at some of these things like gold and some other things that people, conventional wisdom will tell you are good inflation hedges, and examine whether that's really the case. Just because they're generally thought of as being good inflation hedges doesn't necessarily mean that they always are. Again, both the factors that drive interest rates and the factors that drive prices of things like gold and oil and stocks, there's so many driving factors that you can't say it's inflation alone. There are a lot of other things driving this. So some things are good at hedging inflation sometimes, and not so good at other times, and that's really the case with gold. We think that it's probably a much better hedge against crises, if you will. So this chart just kind of shows it's not really up to date, but what we wanted to show here was time periods where there's particular crises. And when you put inflation up against gold, you can see that it really correlates much better when there are crises and sudden movements. And that was the case particularly in 2008 and back in the late 70s with the oil price shocks. And so it's really been much more of a crisis hedge than an overall longer term inflation hedge. And in fact, gold has really lagged CPI pretty consistently from the late 90s through the 2000s. So in a lot of the years, cash actually beat inflation. So it's again not really a very good longer term. It's something I know a lot of people want to have in their portfolio, but again, it's more of a crisis hedge than it is an inflation hedge.
So just to maybe put a bow on gold for a minute here, and we do have another question that might be well answered within that gold and currency space. But to put a bow on gold, so if you're buying gold, you're doing it because you think there might be shorter term risks and maybe a crisis. I did see, the bullet point that talked about when, stocks were actually down around 10%, gold was positive, but it's kind of short windows. So although gold has underperformed CPI long term, it probably overperforms most asset classes during really turbulent times. But the tricky
Absolutely.
part about this is how accurately can you predict really turbulent times? Because we go through, right, we go through a long periods of time where we see markets, let's say equity markets, talking about stock markets moving up and down 5 or 10 or maybe 15%, but I wouldn't really call those crisis. And also we went through crisis of COVID, and you would have kind of expected, I mean, gold did well during that, but you would have expected it to do, in fact, rewind. By the way, rewind a year ago, weren't we at the bottom on the stock market like today? I think it was. It was really close to today. So if
I
you're
think a couple of days ago was the anniversary, if I'm not mistaken.
yeah,
Yeah.
so if you're wanting to get a little dopamine shot, take a look at your 12-month performance on your stock portfolio today.
Yeah.
I'm curious with stuff like that, and I had to look at it, and most stocks are up between 50 and 100% for the last 12 months. But anyway, going
Yeah.
back to gold, just be aware that if that's the hedge you choose to use for inflation, that it may not work out as you expect if you're thinking it's a long-term hedge. You need to be thinking about it in terms of, are we going to see condensed periods of high inflation or condensed periods of turmoil? And in both of those scenarios,
Mhm.
that's where gold is going to play a little better for you. But anyway, there was another question here, Monica. Let's see if you feel like
Mhm.
it's now's the right time. If not, push us to it later. But how does
Mhm.
inflation relate to the devaluation of the dollar, and how does digital currency figure into the equation as well?
Ooh, well, the first part is pretty easy. A weak dollar will tend to be inflationary. Again, it's more about the price of imports, ends up costing us more. Um, the second part, that's harder. Digital currency hasn't been around long enough for us to really have a good long-term view or idea of how that's going to impact um, anything,
Yeah.
the currency, inflation, anything.
Yeah, I
Right now,
just pulled the clip from that grenade and tossed it your way.
yeah,
But I'm gonna pull it back for a second. We've been doing a lot of research on cryptocurrency in general, and
yeah,
that is a space that is absolutely fascinating. And there's the potential for it to become as revolutionary potentially as the internet, and there's a potential for it to just kind of always be this thing on the back burner. And you talk to any crypto fan, and it's the first, right? And you talk to anybody else that maybe is less familiar with it, and it's the latter. It seems as though as we get more education around it and a better understanding, we start to see the applications of it, and we all start to get more excited and understand that this could be a really big thing.
yeah,
There's so much volatility in it. I mean, you need to be ready for 20 to 30% swings on most of these digital assets in a short period of time. So, to the question, there is an absolute possibility that one or two or three or many of these digital currencies or even blockchain technology itself creates an entirely different environment with easier monetary transactions and faster and more verified transactions between people, which in my opinion is actually an efficiency boost, which is helpful and can be deflationary if we have technology helping us transact better.
yeah,
I personally have to wait until they get some other sort of denomination for the Bitcoin, because I can't see myself going out for lunch and saying, "Yep, that on the menu, seeing that combo meal is 0.000008 Bitcoin." I mean, it just seems too complicated. They've got to come up with a better system. But maybe the dollar always stays around and they work jointly, and you
yeah.
convert to Bitcoin, transact, and convert back. There's a lot there, and I think we pause on that and don't go any further because it's just so new and so in its infancy that we
Yeah.
don't know. That's the
It
bottom
is.
line.
Well, I think it's useful, and I won't spend a lot of time on it. But it is useful to point out all the things that you just mentioned. For all those reasons, crypto, any kind of crypto, Bitcoin or whatever, they're not real currencies yet. You can't just go spend them somewhere, anywhere. They're not fungible. You can't bring them anywhere. And so for that reason, they're not going to be impacted by the factors that impact the dollar or any other currency, inflation and so forth. They're really impacted more just by the outlook right now, the supply of it for one thing, that's the big driver, but psychological, people's idea of whether they are going to eventually become adopted widely and become real currency. But there's another case to be made though for that advent of the blockchain technology, perhaps just making it easier for other currencies or accepted currencies to be digitized and used and become more effective and more efficient. And so either we don't need the cryptos down the road, or we don't need them as much. So there's a case there both ways to say, either it really keeps evolving and becomes that currency, or maybe it doesn't. But because of that uncertainty, we wouldn't consider it as an inflation hedge or not, just because right now it's not impacted by inflation. So
yeah, I look at it as a separate asset class to invest in and potentially hit it big. And so if you want to put some small percentage in it, I think that's great. But anyway,
highly speculative.
yeah, super speculative. Okay, so stocks is the next inflation hedge.
So, in stocks, a lot of people might say stocks, really, you don't maybe normally hear of stocks as being an inflation hedge. But when we look at, all of the asset classes and run correlations and say, what really follows inflation to the point where, there's a pretty good chance that when inflation is higher, you're going to outperform it. Stocks is one that actually comes, rises to the top over a 30-year period. The returns in stocks have actually been, fairly unaffected by inflation rates. In the short term, they tend to outperform when inflation is, like 2 to 5%. They maybe falter a little bit if inflation goes above 5%, which of course most people listening to this probably have never don't remember any period when it was a 5% or above. I do, but and that's really, it brings up one thing though, actually, that's a little bit different about this period right now than maybe 30 years ago, maybe not 10 years ago, but in terms of how the stock market is impacted by inflation. You've noticed probably over the last few weeks, as inflation expectations have ticked up, or the fear of inflation has ticked up, that technology stocks, or really all of the big growthy stocks, have not done very well. There's been quite a sell-off in those, and that for that reason, it's because those high growth stocks, tech stocks, tend to not have earnings at all, if any. They have very little earnings. So the way that they're priced, their future earnings are being discounted, into the present. And when you discount future cash flows, the lower you bring the interest rate, the higher the valuation gets. And so very low interest rates tend to favor those growth stocks. It's just makes capital, very cheap for them to continue to grow without having any earnings to show. So as interest rates have ticked up, that's really kind of hurt the growth stocks. It's not killing them. It's just, it's kind of making it harder for people to justify extremely high PE ratios. So that's what is going to tend to happen, I think, even a little bit more in this cycle versus other cycles, is that, if we do see a real uptick in big inflation, that's going to hurt the growth stocks a lot more. But we really, because of, again, we see a better correlation with inflation in stocks, that we think that stocks are probably the best longer term hedge against inflation. And one thing I'll mention here real quickly too, is it brings me back to, we were talking about buying gold, and some of the other things that you might think of as being good inflation hedges. If gold is not a great short-term hedge against inflation, the problem then becomes, if you want to utilize it as a short-term hedge, is you've got to know when to get in and you've got to know when to get out. You've got to be, extremely knowledgeable, and look, have a crystal ball or whatever, and just know when exactly to get in and out. And that's always the problem trying to time any particular markets. If you, even if you are really really lucky and you get out at just the right time, you've got to know when to get back in and catch the ride up, or it doesn't really do you any good. So that's why we think stocks are really a much better longer term hedge, because over very longer periods of time, it's going to tend to outperform inflation. And as inflation declines, PE multiples usually tend to decline as well. But that's more due to just the expectations for the economy in general and growth, because when inflation is declining and it's very low and below zero, that's usually when the economy's in a trough. It's not doing very well. So
Monica, you just understand this so well, and the relationships. I want to see if I can even just bring it like Sesame Simple for on the stocks and interest rate conversation. Do you mind going back one
yep,
slide?
yeah, sure.
So folks here with us today, let's see if we can get through this, because I think there's a lot to this that we don't fully are not fully understanding the correlation between things. For example, if interest rates are low, there's something called a discount rate being used. And this is what Monica went through, but the idea is you as an investor have a choice. You can take your money and you can put it in the bank and earn 0.25% and be almost more mad that they sent you the 1099 for your interest for the year than actually, getting the money or not, right? You're just totally upset. $5 in the bank was not worth the piece of paper. Now, at the same time, if that rate is really low, you have a choice. You can put your money there and earn hardly anything, or you can take your money and you can buy other assets. In this case, Monica's talking about potentially stocks. So if you buy stocks, they have a high potential or a much higher potential for growth. Let's say that you expect these companies inside to earn 7 to 10% earnings growth, meaning the company itself is going to increase their earnings by 7 to 10% per year. And that's actually fairly like muted. A lot of these companies do better than that, some do worse, but let's just use that range for a minute. So you have a choice. Almost 0% interest, 7 to 10% growth over here on the stock side. So when it's that different, when the rates are that different, then all of a sudden more people want to buy stocks, which pushes the price up of stocks, makes them a little bit more expensive. Now, if we see high inflation, this is hopefully the Sesame Simple part. Monica's saying if the rate goes up, then all of a sudden you have that same choice, but the trade-off isn't the same, right? You've got this higher potential rate. Maybe it's in bonds, maybe it's in CDs, maybe it's in cash, which typically produce a better rate of return in those environments with lower risk than buying the stocks. So now you're choosing between a lower risk investment with a decent rate of return, or maybe just a slightly higher rate of return. And the trade-off is tough now. It's a more difficult decision. And
Mhm.
so you maybe don't put as much money towards stocks. There's less buyers on the supply side and demand side of the stock transactions, which maybe makes it so stocks don't perform as well. Also, it's harder for these companies stocks are really just businesses, right? That's harder for them to borrow money at these higher interest rates, which also makes it more difficult for them to get capital and grow. So this is the relationship that we're talking about here. And and really, if interest rates stay low and stay low for a long time, it keeps that trade-off where it's been for the last 5 or 10 years. If interest rates go up fast, then all of a sudden that trade-off is different and the cost of borrowing is higher. And that's where we might see it. Now, Monica, my question for you is, are there certain types of stocks? Because you mentioned tech stocks, and we can understand that for sure because they're looking to grow a lot. So they might want more capital and they want low interest rate environments. But are there certain types of stocks maybe beyond the tech sector that are maybe less interest rate sensitive and inflation sensitive that might do a little bit better? And maybe Kurt, this is actually maybe a question for you, being more on the stock side of it. But maybe that could help us maybe wrap up like it's not just all stocks are going to struggle if we see inflation. Help us out a little bit on that, if you don't mind.
Well, one big one is bank stocks. Bank stocks or really any financials, they tend to do better when rates are higher because of the way they make their money is on the spread between the loans that they make, the deposits they pay money out on. And when rates are very low, that spread is tight. I mean, there's hardly, much way for them to make money. They still make money on fees and stuff. They're not hurting, but they don't make as much money, so they do much better when rates are higher. In general, though, you would think that very capital intensive stocks like John Deere's and building stocks and so forth would do worse when rates were higher. But here's where you sort of get a muddying of the water. There's so many factors going on here. When rates are higher, that's just when the economy is generally doing much better. Business is good, for these companies. So it tends to not have, as much of a negative impact as you think. And they tend to do better, when rates are higher because the economy is doing better.
Yeah.
And
And Monica, can I add something to that
yeah,
as well? I actually, I'll take it one step further. When you study the cycles, Zach, the first leg of rising rates is actually very bullish for stocks. Can I steal the screen for a second?
sure.
Would that be okay?
Yeah.
I think Zach might have to give me permission to do that.
Um,
Do I have to
I'm,
stop?
I'll just stop
Maybe
you.
you
There
stop
you go.
share.
I
Okay.
stopped her, so you should be good
Let
to
me,
go.
let me just show everybody something here real quick. And this is really interesting. So this is the last, so this goes back to the 50s. And this is sort of the rising rate cycles that we've seen historically. And what's really interesting, you see over on the right, is during that period of time where rates are rising, and you can kind of see what, it's a different magnitude of rising rates. But by and large, the impact on the equity market is actually pretty bullish. And it's a little bit counterintuitive. In fact, I would posit, Zach, that I would be really worried if at this point in the cycle, rates kept going towards zero. It would actually be more indicative that there's something wrong with the plumbing in the system. Like we actually, to Monica's point, you want to see rates go up some, because what it's indicating is a much healthier underlying state of the economy. And that's why, to Monica's other point, historically, the most consistent, best inflation hedge are stocks, because as an economy gets healthier, companies are passing that on to the consumer. As costs of things go up, the consumer is going to pay more for goods. That's actually a little bit of that is a really healthy sign. Otherwise, you're slipping backwards into like a Japan style deflation or stagflation, which really, puts a cloud over the economy. So it's our knee-jerk reaction right now to say, oh, this is bad for stocks if rates start to go up. But here's the truth. How many people are going to start selling their stocks to buy treasuries if treasuries move from 2% to 3%, right? I mean,
It's not enough. It's not enough of a
nobody,
move. Yeah.
right? So historically, you don't see stocks getting in trouble until rates start to get back closer to like 5% in treasuries, where people are being tempted out of their equities and into bonds. So anyways, Monica's a lot smarter on this than I am, but I thought I'd add that little bit of color there.
Oh, that's great. That's great. All right. And now I don't mean to belabor that. Let's move on from stocks. And maybe that's just our bias because we love the growth we've seen in them. But let's move on to the next hedge and talk about what's next.
Okay. All right. So let's see. We talked about stocks. As we said, stocks we think are, a fairly good longer term hedge. Oil is one, or just in general commodities. Sometimes people will point out should be good inflation hedges. So we looked at oil. Oil, it had a big run up in the 70s. Again, that was, there were a lot of things factoring in their OPEC and so forth that drove a lot of inflation. But usually once inflation kind of settles down, oil isn't necessarily, the greatest inflation hedge, or it doesn't really correlate as well. And sometimes when there are other things going on with oil, other kinds of shocks, then the relationship also can kind of break down, because while oil is a component of inflation, it's not all of inflation. And the trend kind of before the 80s, there was a trend for oil to kind of mirror inflation a good bit. It kind of deteriorated after the 80s. Then during the 90s, there was a crisis during the Gulf War where crude prices doubled in 6 months, but then CPI stayed pretty stable. And then, that relationship has kind of continued to be somewhat detached from the 2000s on up. So, again, we did see last March, of course, that collapse in oil, but that's, bounced back. So we don't see a whole lot of tie between oil or really any other commodities and inflation. It's kind of like gold, because, there are so many other factors that can drive that it will tend to be somewhat of a hedge during really volatile periods, but then over longer periods of time, not as much. Another thing that people often point out as being a hedge against inflation is real estate in general. It's kind of hard to really study that in terms of any indexes or numbers, but we took a look at farmland because we felt like that it really sort of stripped out, the actual cost of land, as opposed to a lot of REITs that their prices are really more determined by, they might have mortgages in there, or they're operating, real estate as a, drugstore, grocery store, whatever. So there's a lot of other things that go in there that really aren't telling you whether real estate itself is the actual hedge. So we just studied farmland, and it was just kind of interesting because, it actually, farmland has very little correlation to the stock market, or gold. It does have a pretty good correlation though with inflation. A lot of times people refer to farmland as gold with yield because, it does have some income. Gold doesn't push off any income.
Which is our
But
complaint about gold. That's like the normal complaint you hear about gold is I don't get anything from it, which most
right,
land, if you don't farm it, you don't get anything from it either. You just pay property taxes. But I guess farmland is a
correct.
good example where you could actually produce some yield. If I told my uncles who run a ranch in Wyoming that farmland was gold with yield, they would laugh all the way to their grave. Like it's nothing but pain and hard work. But anyway, keep going.
Yeah, well, then that's why, I would say, yeah, statistically, this is one of those things where the statistics tell us that, yeah, it's a pretty decent hedge against inflation, but if you want to invest in it, good luck. It's going to be a pretty difficult thing. You can't, there's no ETF or, anything else out there that you can buy to really get a painless way
Well, and look at Warren Buffett's quote that you put here at the
to invest
bottom.
in it. But it's just kind of right. He said he'd rather own all the farmland in the U.S. than all the gold in the world. So, um, but again, in trying to look at that in theory and then do it in practice, two different things. But it does kind of, I think, also point out though, that real estate in general is probably a pretty good inflation hedge. Again, to try to invest in it as a pure real estate instrument is just very difficult. But it actually is a pretty decent hedge. So, wrapping this up, and we're kind of getting close to time here. We started out talking about what drives inflation, and then, how are we measuring inflation, and some of the factors that we think lead us to the idea that we don't see it as being a huge black cloud out there, maybe a little bit of a head fake early this year, and then probably a return to, a little bit more inflation than we've been used to over the last 10 or 20 years, but definitely not hyperinflation, and probably a little bit of a snap back in interest rates from the run up that we've seen since mid-February, and then probably again that slow march toward a little bit higher rates that typically happens when we get into expansionary periods. We do think we'll probably see 2% on the 10-year. I'm not convinced it's going to be this year. It may be into next year, but that's where we're headed. But it's going to be, I think, a slower march than a lot of people expect. So, and just looking at, what's the best way to protect your portfolio? It's really hard to find good inflation hedges. There's, quickly here, I know we're getting close to time. I just wanted to quickly cover tips because although it's not really thought of as a pure hedge, it is actually the only investment instrument you can buy that's indexed to inflation. So it's the purest form of inflation protection, if you will. But there's a lot of problems with investing in tips, and tips are really, they're treasury bonds. So from a principal, standpoint, you're protected. The U.S. government guarantees them. They pay semi-annual interest. They typically have an interest rate attached to the bond, just like, your normal treasury bonds. The difference is the Treasury looks at the CPI index, and semi-annually they adjust your principal amount to an amount that reflects an increase in inflation, or it could be a decrease in inflation. But your par can't go below the par amount that you paid. So in other words, you might have a price of 100 on $1,000 par bond, and that price could go up to, par and a half, 101, eventually over time, that's going to index upwards. So they're really good at protecting for inflation because they're purely tied to it. But there are some things about it they're a little bit make it a little bit different or difficult, if you will, to implement. And particularly right now, the problem is that most of the pure yield on the actual tips is negative until you get out to like 35-year bonds. You can buy 5-year tips, 10-year tips, 20-year tips, but everything under 35 years is a negative yield. And what that means is, yeah, you'll probably get some positive return over that 35 years or whatever you're investing for, but it will be because that principal has been adjusted upward. So you're getting a little kicker, if you will, that will probably make up for that negative yield. Maybe not. So you're really making a bet. And I actually like to think of it a little bit as buying insurance against you're kind of buying insurance against inflation, and the negative yield is the cost of that insurance. So you're betting that interest rates or inflation is going to go higher than what the expectation is that's built into there. So another issue with buying the bonds themselves is that the adjustment of the principal, that indexing that occurs, that's taxable to you at the time that they tack it onto your bond. So every 6 months, you've got a taxable event, even though you're not getting the money unless you sell the bond or you get it at maturity. So it's not the most tax efficient. And again, they do pay pretty low interest rates typically compared to other treasury bonds or any other bonds. And right now it's negative. So, again, it's a good, you could say it's a good inflation hedge because you're guaranteed you're going to get the return that there is on inflation, but inflation could stay very low. Inflation could even go negative. So there's no guarantee it's going to be a good return.
The investor that was interested in these, I think he ultimately decided not to do any of it because he basically determined that so many people had already priced in potential inflation. So you have to be willing to not make any money if we get expected inflation. And you have to have greater than expected inflation to really fare very well. And you'd have to have not just greater than expected, but greater than expected in a big way for him to make as much money as he had, opportunities in other asset classes. And this person is a fairly high risk tolerant individual. We use risk scores. He's in his 70s and he scores in the 70s every year when I ask him about this. So not super nervous about volatility in other investment classes. So it was hard for him to accept the low rate of return and only benefiting if he guessed better than the general public about inflation. And he guessed that it was greater than what the general public had already priced in. His feelings were that inflation would be about the same as what everybody had already priced in.
Yeah, absolutely. And we've shown here the performance on some tips, and it's okay. It's slightly positive. It keeps up with inflation, but it's never going to be your high performing asset class. So, I guess to kind of wrap it up, again, there's a lot of things that have some correlation to inflation. The only thing that really has the pure highest correlation is tips, and you have to be willing to accept just what Zach said, that you're making a bet that inflation is going to be a lot higher than everybody else thinks it's going to be. If you do, then it's a good hedge. And if you think there's going to be a real extremely high hyperinflation crisis type situation, gold is your better bet. Again, you have to be really, you're going to make a short-term call like that. You have to be really good with the timing. But if you think inflation is just going to slowly trend higher over a fairly long period of time, which is what I would think, the stocks that you already own are really your best hedge against that.
Thank you, Monica. This has been great. I'm going to go ahead and put up contact info if anybody has any questions. Of course, your Capita advisors are happy to help and answer any questions you may have. Somebody asked about where the best place is to put short-term money. Monica, you may have some answers there, but I would say maybe send us an email since we're out of time. And I'd be happy to follow up with that. But my general gut tells me really, really short-term money, and I've talked to this investor about it in the past, is really, really low volatility investments and really, really low yield. You just don't make anything. You just save it instead of losing any potential
You don't. I mean, if anything, the little bit of uptick we've had in the last month or so has made a few things more attractive. Like there's some short-term munis that are actually, decent yields, getting about 70, 80 basis points on a tax equivalent basis, which is not bad compared to money markets.
Right.
But again, that's, I think, you're doing that, you're making a bet that in the next year to 2 years that we're going to see much higher rates, and that'll be good for you. You'll have your money to reinvest at higher rates then. But that's not a given.
Yeah, and I
I
get the
actually
question.
think we're
Go
looking
ahead.
at 2 to 3 years. Yeah.
Yeah, I get the question a lot about not necessarily having that money to reinvest, but it's money that's going to be spent on something big, a big purchase or something like that. And that's where I get more nervous, because I don't want to change your retirement plans because we chose to take a risk that we shouldn't have with money that's 1 or 2 years out. But yeah, that's where the individual planning comes in, and speak with your advisor. This person works with me directly, so speak with me and we'll talk about it. But we should be in good shape. I'm going to queue up my daughter to read our disclosures here, and we're going to call it a day. Sound okay, Monica?
Yeah, great.
All right. Thank you.
The opinions expressed in this program are for general informational purposes only and should not be considered as advice or a recommendation. Opinions expressed by guests do not necessarily reflect the opinion of Capita Financial Network. Past performance discussed is no guarantee of future results. Capita Financial Network does not provide tax or legal advice. If you have further questions, please contact your financial advisor.